Hey everyone, welcome back to the Deep Dive. We've got a really interesting stack of recent sources today. They're all from the Insights section of Fundamental, and they dig into what's happening right now in financial markets and, the global economy. Our mission, pretty simple. Pull out the most important nuggets from these articles and figure out what they could mean for you navigating all this.
Exactly. It's about connecting the dots, right? Seeing how these different pieces fit together to give us a clearer picture than just looking at headlines alone.
Okay, let's get into this stack then. We'll start with the most recent one titled Heat is On. This one throws us straight into how geopolitical stuff is hitting the markets. It mentions the recent Israeli strike on Iranian infrastructure.
Right, related to uranium enrichment.
Exactly. And the market reaction was, pretty much what you'd expect in some ways. Equity indexes dipped, gold and oil popped up, dollar was kind of flat. But the really interesting part, the US 10-year Treasury yield actually rose.
And that's key. The source flags this, saying evidence is piling up, suggesting treasuries might be, losing some of that classic safe haven shine.
Losing their mojo a bit.
Sort of. The thinking is, with all these tensions, Russia, Ukraine, Iran, Israel, the odds of escalation go up, impacting things like oil flows, global trade, and maybe treasuries aren't the automatic first port of call anymore when things get shaky.
Okay, so if treasuries are acting a bit differently, it makes you wonder, who is buying all this U.S. government debt? Which brings us neatly to the next source, Treasury Dynamics. This one digs right into that question.
Yeah, and it points out some interesting shifts. Your traditional big buyers like China and Japan, they seem to be quietly trimming their holdings, and even institutional investors are apparently offloading some private funds.
So who does that leave?
Well, it puts more pressure on domestic banks. They're sort of the natural buyers, but they're in a bit of a tricky spot right now. They're sitting on these pretty significant unrealized losses on their existing treasury portfolios.
Because rates went up so much.
Exactly, duration risk. The source says it's like 15% of their capital tied up in those paper losses. So the article really asks, can treasuries still cushion a crisis when government debt is heading towards $37 trillion, the deficit's at 7% of GDP? It even floats the idea the Fed might have to become the buyer of last resort in a, quote, full-fledged way.
Wow, okay, that whole conversation about buyers and supply pressure links directly to this next piece, bond market dynamic. And this one highlights a really stark contrast, globally speaking. You look at Switzerland.
Negative yields.
Right, negative yields out of 5 years on their curve. Meanwhile, the U.S. is fighting just to keep bond yields below 5%. And get this, the source says half of all bonds issued globally last year were U.S. Treasuries. Half.
That sheer volume plus the higher long-term rates here is really squeezing other parts of the bond market. Mortgages, munis, borrowing is getting expensive. Corporates are quiet too.
Was that?
Well, think about it. Companies locked in super low rates a few years back. Why would they refinance now? Even if spreads are low, the underlying treasury yield, the basis, is high. So it just doesn't make sense for many. The source notes the average price for the ICE BOFA index is like 95 cents on the dollar. And it asks this kind of wild question.
Yeah.
Could we actually see negative corporate bond spreads someday? Just like negative government yields seemed impossible once?
That's a thought. Okay, so we're seeing these big shifts and pressures in U.S. bonds. This next source, fixed income rotation, suggests this rotation idea isn't just for stocks, it's happening in fixed income too.
Absolutely. If you look at a quilt chart of year-to-date returns, what's doing best? It's emerging market debt, both local and hard currency, and the global aggregate index excluding the U.S.
So basically anything but U.S. dollar assets.
Pretty much. The source ties this to what it calls a programmed weakness for the dollar. This makes EM assets look, pretty attractive. Compelling valuations, potential for double-digit returns maybe next year. If U.S. treasuries are under pressure from the budget and debt situation, suddenly almost everything else globally looks better on a total return basis. Plus, the hedge costs now actually favor international assets. That's an extra kicker.
Interesting. And speaking of debt and global shifts, it's not just the U.S., is it? Let's look at German tailwinds. This piece points out that Germany, usually seen as the fiscally responsible one in Europe,
the anchor,
they're also leveraging up, partly driven by boosts to military spending, partly nudged by the U.S. wanting allies to contribute more, especially with Ukraine.
Right. And Germany's debt to GDP, which was historically pretty good, around 65%, this source projects it hitting 80% in 5 years, maybe even 90% by 2035.
That's a big jump.
It is. And you combine that government spending with a, quote, very dovish ECB. Their official rate is still only 2.15% pumping in liquidity. Politicians are leaning towards spending. The result, the source calls it an incredible tailwind for European stocks. The German DAX ETF, for instance, up 35% year-to-date in US dollars. That's widening the gap with the US market, which it says is fighting to remain flat.
Okay, let's pivot back to the U.S. picture with Out of the Woods. This tackles the uncertainty as we near the end of the first half. Q1 GDP was actually negative.
Yeah, but largely due to that import spike, right? Companies front-loading before potential tariffs.
Exactly. And then Q2 saw imports plunge, suggesting maybe a growth rebound. So recession probabilities might have eased off a bit.
Yeah.
But the source asks, are we really out of the woods? And the answer is probably not.
Concerns remain. Corporate earnings estimates are being revised downwards. Now, the 3.5% revision mentioned isn't like catastrophic compared to maybe low double-digit hopes initially, but it's the biggest downward revision shown.
And it's still all about the big guys, isn't it?
Very much so. The source highlights that huge earnings growth is concentrated in the Mag 7, like 17% expected growth there versus maybe 7% for the other 493 stocks in the S&P 500. And the big question mark is tariffs and trade talks, given how tied these giants are to China. That impact is still pretty unclear.
Right. Okay, one last piece here, titled Odds. This one gets a bit philosophical about recessions. It notes the difference between the technical definition to negative GDP quarters and the official call from the NBER, which can be more subjective.
Yeah, the NBER looks at a broader range of data, and the source mentions that, say, Goldman Sachs indicators currently put U.S. recession odds around 17%. But, and this is the crucial point, the path isn't smooth. Things like the VIX, credit spreads, they can blow out quickly. The odds could triple almost overnight.
So it's not a straight line prediction.
Not at all. And the source leaves you, the listener, with some good questions. What changes in your portfolio if the probability hits 51%? When do you consider it certain? And does any probability model really tell you what the NBER committee will eventually decide anyway?
Wow. Okay, so we've covered a lot of ground. Geopolitical tensions possibly reshaping treasuries, questions about U.S. debt buyers, a potential shift to international bonds and European stocks, that ongoing U.S. economic uncertainty, and how we even define a recession. It really feels like the investment world is juggling a lot of different balls right now.
Definitely multiple cross currents, yeah. A complex picture.
It is. So here's something to think about. If those traditional safe havens like treasuries are being questioned and debt is piling up globally, where does real safety, or maybe real opportunity, actually lie in this increasingly uncertain world?